Our next guest says there is still gas left in the tank despite today's higher inflation print. Joining us today from the airport, Tom Lee, Fundstrat Global Advisors, head of research. Tom, we were looking at your photo on social media a moment ago. Thank you for joining us even from the gate.
Yeah, glad to be here, Carl.
Tom, you literally wrote before the CPI print that there could be a non-intuitive outcome, and that is you get a hot CPI print, markets rally, and that's what you would consider to be a bad news priced-in scenario. Is that what we have?
Yeah, it looks like it. I think, the bond market was bracing for a hot CPI print. That's why the inflation break-evens had drifted towards 4, and I think equity markets were kind of nervous ever since Friday. So we got sort of that rip the Band-Aid moment where it was a hot CPI print, and the markets are rallying. I view it as a good sign. But I also think when people look at the details of that CPI report, I'm left with the idea that there's this residual seasonality that makes the January and February CPI look worse than it is. And in the next couple of months, it really should start to normalize, and that's going to be maybe what the stock market's discounting.
You've been pretty candid in recent months, Tom, about warning clients about what you see as sort of tactical, treacherous territory. I think it was maybe last August you said, look out, tactically we might be in for some pain. Are you seeing any repeats of that?
I think it's still early days, Carl. It is a maturing rally because we're now in the 20th week, and this is longer than the last two rallies since October 2022. The longest before that was 19 weeks. But I think there's fundamental anchoring that's supporting why stocks should rise, and I think positioning is still really light, but we could see it in the margin debt being low and the record cash on the sidelines. So I think that's why we feel there's gas in the tank, and Mark Newton, our head of technical strategy, still sees pretty good breadth and a pretty healthy market. So I think today overall is a good sign. We had a bad CPI print in markets out there. I mean, that's always good.
So I take it then, Tom, you disagree with the notion that Jamie Dimon shared yesterday that there's a little bit of bubble in equity markets right now?
I think it's hard to distinguish what's a bubble versus what a market's repricing, because this year, 30% of the S&P earnings growth came from NVIDIA. That's not a bubble. It's really just this big step up in demand, and we've seen a lot of use cases for AI, and companies talk about how much it's added productivity, like Klarna, which is a buy now, pay later company. So to me, I think there is a fundamental story anchoring this that's causing future growth to go up, and it could feel like a bubble, but it's really a market sort of recognizing a megatrend.
Tom, at what point do cuts become critical to supporting these valuations versus the prospect of cuts?
I think it's going to be important. To me, if the Fed raises rates this year, I don't think the S&P would be going up because, it means that the framework's been wrong. So I think a Fed not cutting is also not a great outcome. I think cuts have to happen this year. But I think there's some patience in equities because I think that investors are starting to understand the residual seasonality that's making January and February look like inflation's picking up, but it probably starts to tank in the second half.